Over $1 trillion just evaporated from the cryptocurrency market in less than 72 hours. Bitcoin dropped from near all-time highs to levels that wiped out billions in leveraged positions. Ethereum followed, altcoins collapsed, and the entire financial media is telling you this is just another correction, just another cycle, just the market being the market. But what if I told you this wasn't a crash at all? What if this was the opening move in something far more deliberate? Something that's been planned for months, executed by players most people don't even know exist, and designed to reshape the entire cryptocurrency landscape before the next bull run even begins? Stay with me. Because what I'm about to show you in the next 60 seconds will completely change how you understand what's really happening to digital assets right now. The headlines are calling it a crypto winter. Analysts are blaming over-leveraged traders and profit-taking after the rally. Regulators are pointing to instability and saying this is why the industry needs more oversight. And retail investors are panic selling into the bottom, convinced they missed the top and need to cut their losses before it gets worse. But none of that explains what actually triggered this. None of it explains why the selling started exactly when it did, why certain wallets moved massive amounts of Bitcoin hours before the drop, or why institutional players have been quietly accumulating during the entire decline. This isn't chaos, this is choreography, and the people orchestrating it have done this before. They did it in March 2020 when Bitcoin dropped to $3,800. They did it in May 2021 when China banned mining. They did it in November 2022 when FTX collapsed. Every single time, the pattern is the same: massive coordinated selling, panic in retail markets, then silent accumulation by the institutions who caused the crash in the first place. But this time, something's different. Because this time, the reset isn't just about shaking out weak hands. It's about positioning for a structural shift in how cryptocurrency gets regulated, traded, and controlled at the institutional level. And if you don't understand what's happening right now, you're going to wake up in 6 months wondering why Bitcoin is at $150,000 and you're not holding any. Let me break down exactly what's unfolding. The crash started on a Sunday evening. That's already unusual. Major market moves rarely happen on weekends when liquidity is thin and most institutional desks are closed, but that's exactly when this one began. Bitcoin dropped 8% in under 2 hours. No major news, no catalyst, just sudden aggressive selling. Within 12 hours, the entire market followed. Ethereum down 11%, Solana down 15%. Smaller altcoins lost 20, 30, even 40% of their value. Liquidations cascaded across every major exchange. Over $2 billion in leveraged positions got wiped out in a single day. And here's where it gets interesting. While retail traders were panic selling and taking losses, blockchain data showed something completely different happening in the background. Large wallets, the kind held by institutions and high net worth individuals, were absorbing the supply. They weren't selling. They were buying, quietly, methodically, at prices retail was desperate to exit. This is called a liquidity grab. And it's one of the oldest tricks in traditional finance, now being executed perfectly in crypto markets. But why now? Why trigger this specific crash at this specific moment? To answer that, you need to understand what's been happening behind the scenes in institutional crypto infrastructure over the last 6 months. In November, Singapore Exchange announced it was launching Bitcoin and Ether perpetual futures. That's significant because Singapore is one of the most tightly regulated financial centers in the world. They don't approve products unless there's institutional demand and regulatory clarity. The launch means major players are positioning for long-term exposure to crypto through traditional financial channels. Around the same time, multiple reports surfaced that several sovereign wealth funds and pension funds were in final stages of approval for direct Bitcoin allocation, not through ETFs. Direct custody. That's a massive shift. It means the largest pools of capital on Earth are preparing to enter the market not as speculators, but as long-term holders. And just weeks before the crash, the Financial Times reported that several central banks were exploring frameworks for holding digital assets as part of reserve diversification strategies. Not stablecoins, not central bank digital currencies, actual Bitcoin and Ethereum. So you have institutions preparing to buy, you have regulatory clarity improving in key jurisdictions, you have infrastructure being built for massive capital inflows, and then suddenly the market crashes. Coincidence? Or the perfect setup for accumulation at suppressed prices before the real move begins? Here's what most people don't understand about institutional entry into any market. They don't buy at all-time highs, they don't chase price, they create the conditions for price to come to them. And the easiest way to do that in a relatively small market like cryptocurrency is to trigger a liquidation cascade that forces weak hands to sell at a loss. Think about it. If you're managing a sovereign wealth fund with instructions to acquire $10 billion worth of Bitcoin, you don't just market buy and push the price against yourself. You wait for a crash. Better yet, you help create one. You coordinate with other large players to sell aggressively during low liquidity windows. You trigger stop losses and margin calls. You let fear do the rest. Then you accumulate slowly over weeks while everyone else is convinced the market is dying. That's not conspiracy, that's strategy, and it's exactly what the data is showing happened here. But there's a deeper layer to this. Because while the market was crashing, something else was happening that almost nobody noticed. Regulatory frameworks were advancing. In the chaos of a market collapse, when everyone's focused on price action and trying to salvage their portfolios, policy moves forward without resistance. Just days after the crash began, multiple jurisdictions quietly moved forward with stablecoin regulation frameworks, the kind that separate compliant, institutional-grade stablecoins from unregulated offshore alternatives. That's not coincidental timing, that's deliberate. Because here's what's actually being built right now. A two-tiered cryptocurrency system. One tier for institutions, fully regulated, fully compliant, with access to banking infrastructure, custody solutions, and legal clarity. And another tier for retail, offshore exchanges, unregulated stablecoins, and constant uncertainty. The crash is the transition point. It's the moment when the Wild West era of crypto ends and the institutional era begins. And the people who understand that aren't selling. They're accumulating as much as they can before the structure fully locks into place and prices reflect the new reality. Let me show you how this plays out in practical terms. Right now, Bitcoin is trading significantly below where it was 3 weeks ago. Retail sentiment is bearish. Fear and uncertainty dominate social media and trading forums. Most people think this is the beginning of a longer downturn. But institutional bid depth on major exchanges has been increasing, not decreasing. That means there are large buy orders sitting below current market prices, waiting to absorb any further selling. That's not bearish behavior, that's accumulation behavior. At the same time, Bitcoin ETF inflows in the United States haven't stopped. Even during the crash, certain institutional ETFs continued seeing net positive inflows. That means professional investors are using the crash as an entry opportunity, not an exit signal. And offshore, in jurisdictions with less transparency, over-the-counter desks have reported record activity. That's where institutions buy large amounts without moving market prices. It's invisible to most traders, but shows up weeks later when supply suddenly tightens and price starts moving higher without obvious cause. All of this points to the same conclusion. The crash was the setup. The reset is already happening, and by the time it becomes obvious to the broader market, the opportunity will be gone. Now here's where the story gets even more interesting, because this isn't just about Bitcoin. This is about the entire architecture of digital finance being restructured in real time. Stablecoin regulation is the key. Once governments establish clear rules for which stablecoins are legal and which aren't, they effectively control the on and off ramps for the entire crypto ecosystem. You won't be able to move money freely between exchanges, wallets, and traditional banking unless you're using approved stablecoins issued by regulated entities. That sounds restrictive, and it is. But it's also the exact clarity institutions need to deploy massive capital. They won't enter a market where the fundamental infrastructure could be shut down by regulatory action at any moment, but once that risk is removed through clear legal frameworks, the floodgates open. And that's what this crash is really preparing for. The final regulatory pieces are falling into place. The infrastructure is being built, and the market just got reset to prices that make institutional entry attractive instead of risky. You're watching the bridge being built between traditional finance and cryptocurrency, and the toll for crossing that bridge is compliance, regulation, and consolidation. The wild, decentralized vision of crypto that early adopters believed in is being replaced with something far more controlled, but also far more valuable, at least in price terms, because institutional capital doesn't flow into chaos. It flows into structured, regulated markets with legal clarity. So what does this mean for someone holding cryptocurrency right now or thinking about entering the market? It means you're at an inflection point. The crash scared out most of the retail traders who were going to sell. The weak hands are gone. What's left is a market being quietly accumulated by the players who understand what's coming next. If you're waiting for confirmation, for prices to start moving higher before you buy, you're going to miss the entry point. Because by the time it's obvious that the bottom is in and the next leg up has started, institutional accumulation will be complete and prices will already reflect the new reality. But if you understand that crashes like this are a feature, not bugs, of how markets transition from one phase to another, then you see this for what it actually is: an opportunity disguised as disaster. The $1 trillion that disappeared from crypto market cap didn't vanish into thin air. It transferred from leveraged speculators to patient accumulators, from retail panic sellers to institutional bid depth, from weak hands to strong hands. That's how every market cycle works. And crypto, despite all its claims of being different, follows the exact same pattern. Here's the final piece most people won't figure out until it's too late. This crash, this reset, this entire sequence of events, it's not the end of the bull market. It's the prerequisite for the next phase. You can't have institutional adoption without regulatory clarity. You can't have regulatory clarity without market structure, and you can't build market structure while prices are running parabolic and retail speculation dominates. You need a crash. You need fear. You need consolidation. And then once the infrastructure is in place and the weak hands are gone, you need a catalyst. And that catalyst is already being built. It's the approval of new financial products. It's the entry of sovereign wealth funds. It's the quiet accumulation happening right now while everyone else is convinced the market is broken. Bitcoin's secret reset isn't happening in some distant future. It's happening right now, in real time. While retail sells and complains about manipulation, institutions are building positions that will define the next cycle. While fear dominates sentiment, the infrastructure for the next bull run is being constructed. And 6 months from now, when Bitcoin is trading at levels that seem impossible today, people will look back at this moment and realize this was the opportunity. This was the reset. This was the point where the market transitioned from speculation to institution, from chaos to structure, from gamble to asset class. But the real shock comes when you realize this isn't just about cryptocurrency. This same pattern, this same reset mechanism is being deployed across every major asset class right now. And the next crash, the one that makes this look small, is already being positioned for